There's no absolutes in life, I've learned. There's only probabilities. And the probabilities are that precious metals are going to do extremely well. It's difficult for me to imagine why somebody wouldn't have some of their liquidity, at least in gold and silver.
Please join us for our next live stream, Sunday, July 3rd at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, July 3rd, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Rick Rule joins us once again today. Rick is a highly experienced investor and speculator focused on sub-1 billion market capitalization, public and private issuers in natural resource industries. Rick has structured, led, and participated in hundreds of privately placed debt and equity issuances for resource companies operating internationally and in the U.S. And Rick is a sought-after investment conference speaker as well, having presented at hundreds of resource and investment conferences over the last 30 years. And we are delighted to have Rick join us once again today. It's time to saddle up and silver up for Rick Rule. Rick, welcome back to SBTV. How are you doing?
Patrick, it's always a pleasure to be with you. Thank you for having me back.
Glad to have you back. Can never have enough of you, Rick. So far in 2022, the year has seen a high-profile Russia-Ukraine war, rising inflation, rising resource, fuel, and food shortages, stocks and Bitcoin crashing, and rising interest rates, albeit still low compared to the 70s. Rick, what do you make of this time that we live in, and have you ever seen parallels to this before?
I think it was Mark Twain that said that history never repeats, but it rhymes. And I think that what we're seeing now is the result of policy actions and political actions that while in detail we might not have understood the necessary outcomes, from a very broadly based point of view, I think we do understand the outcomes. The outcome, as an example of a highly politicized society or series of highly politicized societies, increasing nationalism and reduced trade, is probably war. So in that context, the idea that groups of people feel that they deserve outcomes which are based in politics rather than based in creating utility for others, the sort of resentment and tribalism that is the consequence of politics normally results in war. So that's one thing that happened. A circumstance where, too, the economy, and in particular the market for money, is taken away from the free will of individuals and the direction of interest rates, and in fact the very supply of money is controlled by political classes, probably always leads to negative real interest rates and inflation. And so although it took 20 years, or some would say 40 years, for that circumstance to come to pass, it too was predictable. You and I have talked about that on prior shows. The idea that politically you can have a war on savers on behalf of spenders, who are of course more numerous, will always means that you have artificially low interest rates. And the outcome of artificially low interest rates is, of course, inflation. The outcome, I suspect, of 2 decades of easy money, and the outcome of 2 decades of both investors and speculators believing that the Fed will always have their back with regards to asset prices, probably led to the asset bubbles in things like non-revenue tech stocks and in some of the more unpronounceable cryptos. So I would suggest that everything that we're going through today, had we stopped and thought about it over the last 20 years, could have been predictable. Did we predict it? Not in every case with every person. And I think, Patrick, that's explainable too by way of human nature. People's expectation of the future is set by their experience in the immediate past. And if their experience in the immediate past is benign, which is to say, if the big thinkers get away with quantitative easing, if the big thinkers get away with negative real interest rates, if the big thinkers get away with jingoistic xenophobic racism, the normal, predictable outcomes over time are negative. But if they get away with it in the short term, the expectation is that they'll get away with it in the future. 2022, I guess, could be regarded as a sort of a down payment on the reckoning. The fact that actions have consequences, and not all of the actions that have taken place in the last 20 years are going to necessarily have good outcomes.
Yeah, I guess one of those big thinkers was Janet Yellen, who misunderstood inflation. I don't understand that one. But Rick, do you get the feeling that so much money has been printed more so than at any other time in history, and an extended period of misallocation of resources, that no one really knows what is the end game that all this money printing is going to bring on?
I do. And I'm not sure, given the structure of the economy and given the expectation of voters, how they end the period of easy money. Let's, just for fun, do a little bit of arithmetic, Patrick. I know that's nobody's favorite topic, but it explains a lot of things. Let's look at the interest rate on the U.S. 10-year Treasury. It's up a little above 3 now, having been as low as 1.2. That tells you one thing. It tells you that perhaps the 40-year period of lower interest rates, perpetually lower interest rates, is over. But the arithmetic survives the comment, which is to say that the most important security yield in the world is the U.S. 10-year Treasury. And at 3.1 or 3.2, it is, to quote Hayek, a certificate of guaranteed confiscation, because you're earning 3% in a currency that the U.S. government says is declining in purchasing power by 8.6% a year, meaning that the U.S. government absolutely, positively promises to cost you 5% plus of your wealth every year, cumulative and compounded for 10 years. Now, if you look back over the last 40 years, for most of that 40-year period, the U.S. 10-year Treasury has had a yield that was positive after the CPI stated rate of inflation. That would mean that a return to mean in terms of the 10-year yield on the U.S. Treasury would have a 9 handle or a 10 handle. Equally odd, the U.S. 30-year fixed mortgage rate has traditionally traded at a premium to the U.S. 10-year Treasury rate, which means that the U.S. 30-year fixed mortgage rate, in order to revert to mean, would have to have sort of a 10 handle on it. Imagine the impact on the U.S. economy if the U.S. 30-year mortgage rate, rather than being at 4.3, was at 10. Imagine the impact on housing starts. Imagine the impact on home affordability. Imagine the impact on housing prices. Imagine, too, if we had a reversion to mean to a positive yield in the U.S. 10-year, what that would do to the rest of the credit stack. One would expect, as an example, that consumer credit, represented by mass-marketed credit cards, would climb from some number like 10 or 11, where it currently is, to some number like 18 or 20, where it used to be. That would have an interesting impact on consumer spending, and particularly consumer durables. Imagine, finally, the impact on federal, state, and local government budgets if the interest component on the debt that they had to service tripled. The point of all that mind game is to let people know that in the intermediate term, there probably isn't a way for Janet Yellen and the big thinkers to allow reversion to mean. And without a reversion to mean, with a continuation of excess money supply, and in particular artificially low interest rates, it will be very, very difficult for them to deal with inflation.
I've seen the commodities versus Dow Industrial Average chart, and it shows commodities to be most undervalued in 120 years. At a time when we have more people on the planet than ever before and are producing things faster, yet consuming more, how can commodities lag behind stocks so badly?
I think that in some senses, forward commodity prices are a function of two things. One, maybe three things. The incredible efficiency with which extractive industries, oil and gas and mining industries, discovered new resources and reserves in the 1970s and 1980s, particularly because exploration began to take place outside of familiar terrains, which is to say, as an example, African deposits, Asian deposits, South American deposits were brought into production. Two, technology has allowed us to be much more efficient in the utilization of resources, which is to say, our fabrication efficiencies through technology are much greater than they used to be. So a barrel of oil or a ton of copper goes a lot further with today's recovery and fabrication technologies than it did 40 years ago. But also, commodity markets are forward-looking. And I think commodity markets today are taking into account the possibility, if not the probability, of a global recession. We've gone for a very long time without a recession. And despite the fact that everybody sees that supply shortages are going to happen relative to our traditional productive capacity, people are concerned that demand will suffer too in the event of a global recession. I agree with your assertion that commodity prices are unrealistically low viewed against a 100 or 150 year time frame. I would postulate further, and I'm happy to defend this in some future interview, that as a society we have been underinvesting in the productive capacity around industrial commodities, oil, gas, uranium, copper, the whole range. We've been underinvesting as a society for 30 years, not just for 10 years. And the consequence of that is inevitably that we will continue to experience short supplies of commodities, particularly as the population on Earth continues, and particularly, too, as we do an admirable job, as we have done in the last 30 years, in increasing the material living standards of the poorest of the poor. It's important to remember in any discussion like we're having, Patrick, that over 1 billion people on Earth have no access to electricity. And another 2 billion people on Earth have access to only intermittent or unaffordable electricity. Those people want to live like you and I do. And when poorer people get more money, the type of purchases that add utility to them and their families are almost always material. When you make more money, you buy a service or maybe some little gadget from Apple, which doesn't require very much by way of raw material. But when a poorer person acquires more purchasing power, they increase the calorie count and the calorie quantity in their family. They trade a bicycle for a 50cc motorcycle and a 50cc motorcycle for a Toyota Hilux, which is to say, in every circumstance, when the poorest 3 billion people on Earth get additional spending power, what they spend the money on is commodity intensive. And that demographic wave of demand is running into a supply crunch that stems from 30 years of underinvestment in productive capacity, which is itself exacerbated by politics, by increased social take by way of taxes and fees, by permitting and regulatory regimes that prohibit, never mind the construction of new mines, but even, in fact, exploration for same. So it's going to be an interesting period of time for people in the commodities business, and I suspect a very pleasant period of time for companies and individuals that own long-lived, high-quality reserves, which will be very tough to replace, given the level of investment activity that's taking place now.
Yeah, Rick, that's an interesting point. Why would politicians stop the exploration of resources and all of these things? Why would they stop investing and going back into these natural resources?
I can only speculate, but there is a preference among some citizens and developed nature for a sort of a Luddite future. Perhaps it's that people in places like the left coast of the United States have theirs, and they care less about the well-being of people who don't have theirs. The suggestion, as an example, that we're going to be able to feed 8 billion people in the globe with organic farms, I think is part of the same social ethos that causes us not to be able to build pipelines, not to be able to build power plants, not to be able to build the power grid, and in many jurisdictions, not to be able to even permit the exploration, never mind the development of resources that the world needs to lift up into material prosperity the poorest of the poor.
If you're enjoying this interview with Rick Rule and I, please consider subscribing to our YouTube channel, sharing this video, and giving us a thumbs up to let the algos know you want more content like this. And if you want to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Rick, are we about to see a commodities bull market happen soon? And what would you hazard a guess to be the trigger for this rush into commodities?
Well, I would suggest that when you ask when the commodities bull market is going to occur, that you fix the starting date at 2019, which is to say, I would suggest that we're already 3 years into it. I remember in the middle part of the last decade, the copper price at $1.50. I remember the oil price for a while being sub-zero. I remember the gold price at $1,000 an ounce. So from my viewpoint, when you ask the question, when will the bull market begin? I would say 3 years ago. I would say that we're in a hiatus in the bull market. And a hiatus in the bull market is very, very consistent with past experiences. Most investors perhaps are young enough or don't have good enough memories to recall earlier natural resources bull markets, but they have surprising duration. The first one, in my experience, began in 1970 and ended, by my count, in 1981, which is to say an 11-year bull market. Note that we're 3 years into this one. The second one in my career began arguably in 2000 and ended in 2011. Coincidentally, another 11-year bull market. So when people say, on the one hand, when will we enter the bull market? I would say 3 years ago. When people ask me how long it can go, I would suggest a decade. The other thing that people forget about these bull markets is the dimension, not the duration. My first bull market saw the oil price begin in 1970 at about $3 a barrel and end in 1981 at about $30 a barrel. Saw the gold price go from $35 to $850 an ounce. The same sort of thing, albeit to a tamer degree, happened in the 2000 to 2011 bull market. The copper price went from below $1 a pound to almost $4 a pound. The gold price went from $256 to $1,900. The oil price went from $12, $13, $14 a barrel to $120 a barrel. So people underestimate both the duration and the dimension of bull markets. What surprises them negatively is the volatility in those bull markets, which is to say 20 or 25% or 30% declines in a cyclical bull market, while unnerving, are commonplace. And you can have a hiatus in those bull markets, much like we experienced in 1975, or like we experienced again in 2002 and 2008. And these periods, I would call them hiatus periods, can last 18 to 24 months and can feature commodity price declines of 25 or 30%, and equity price declines, if you go back to the 1975 market, of 50%. So somebody who is casting some part of their future in a commodities bull market needs to understand it isn't going to be straight up. It isn't going to be stair steps to heaven. There's going to be lots of volatility. But they also need to understand that in terms of its dimension and duration, if you are careful but optimistic, there is a tremendous amount of money to be made in bull markets. And I would suggest that this one has a long, long way to go, although it might go lower first, or although after the rebound in this market, there may be another subsequent decline.
Rick, the dollar's at 104, 105 on the DXY. Do you think that is causing somewhat of a headwind or a little bit of the hiatus for commodities?
I absolutely do. The US dollar, for all its sins, is the world's reserve currency. And the US dollar continues strong. The ability that the Fed has had to allow nominal interest rates to rise when other societies haven't been able to do this has strengthened the US dollar. My good friend Doug Casey describes the US dollar as the prettiest mare at the slaughterhouse, suggesting that rather than being strong, it's relatively strong against other currencies, other floating abstractions that are even more wounded than the US dollar. I would expect that the strength in the US dollar might continue for another 6 months, provided that the Fed can continue to increase nominal interest rates while other societies don't have the ability to do that. It is odd that you see a period that has the strength that we've seen in the US dollar that is accompanied by relatively strong gold prices simultaneously. Generally, when the dollar does well, gold does very poorly. And to see the dollar hold its own in dollar terms means that gold is in a raging bull market if you denominate it in Turkish lira, in Japanese yen, in Chinese renminbi, in the pound, in the euro. And I think that's important to note that.
Regarding the rate hikes, the Fed pushing rate hikes, will this quote or unquote, and you kind of touched on this, fix things or bring on that day of reckoning? I mean, higher interest rates against a mountain of debt to be serviced is never really a good mix.
That's the $64 trillion question, Patrick. A bit above my pay grade. I personally believe that there is too much debt in society, and there's too much reliance on debt, both in the economy and in the political equation, for the Fed to continue for too much longer. Could it go on for a year? Absolutely. And I certainly hope that they are able to continue to let the interest rate rise, because taking the steam out of the economy gradually, I think, is a very good thing. The Fed desperately needs the ability to achieve their political ends, to lower interest rates at some point in time in the future. It's tough to lower them below zero. So the idea, as an example, that they've been able to increase the yield on the US 10-year from 1.2 to 3.2 is a very good thing. It would be very useful for them if they could get it to 5. If they got it to 5 and they subsequently needed to bring it down from 5 to 2.5 to inject liquidity in the system, that would give them the tools to do it. It doesn't solve their problem, or rather, it doesn't solve our problem, which is to say, it doesn't put the economy on a good footing, but it does solve their political problem.
Seems to be really quiet on the gold and silver front during this period as precious metals prices approach 2 years of consolidation since their last peak back in August of 2020. Are you feeling that we are in a darkest before dawn phase for gold and silver right now? And is morning coming soon?
There's no absolutes in life, I've learned, Patrick. There's only probabilities. And the probabilities are, unfortunately, that precious metals are going to do extremely well. I say unfortunately because precious metals have had a role for a millennia as insurance, insurance against the failings of government-inspired savings and credit instruments. Let's look at the reasons why it's probable that precious metals prices go higher. And I should say that precious metals prices generally go higher when people are concerned about the maintenance of the purchasing power of their investments and savings in other instruments. So why might people be concerned? Well, quantitative easing would be the first. We said this on your show before, Patrick. If you did it, it would be called counterfeiting. But creating more currency units with nothing to back them, whether you agree with it as policy or not, devalues the existing units in circulation. There can be no getting around that. The second is, of course, debt and deficits, which is a creditor, which is to say, as a bond buyer or a depositor, what you are. I don't know the numbers for other parts of the world, but in the U.S., the on-balance sheet liabilities of the U.S. government is approaching $31 trillion. 23 trillion net of the Fed's balance sheet, which is to say net of counterfeiting. But the off-balance sheet liabilities in the U.S. are even more staggering. The net present value, not the long-term nominal value, but the net present value of on-balance sheet liabilities of the U.S. government, things like Medicare, Medicaid, Social Security, pension benefit guarantee, exceed $125 trillion. So the on-balance sheet and off-balance sheet liabilities at the federal level before state and local debt approach or exceed $150 trillion. And we propose to service this debt with a budget that is itself in deficit as to $2 trillion a year. Rather than service the debt, we add $2 trillion a year to it. That might cause people to be concerned about the efficacy of the U.S. dollar and U.S. dollar-denominated savings products. But the worst is, of course, negative real interest rates. The idea that savers forestall consumption and assume credit risk against a guaranteed loss. The idea that you save at 3% in a currency that's depreciating at 8.5%. By its very nature, the fact that you are guaranteed to lose money on savings instruments, guaranteed to lose purchasing power on savings instruments, I would suggest almost guarantees inflation. Now, let's look at two other pieces of math. The first is that despite all these tailwinds, precious metals are broadly underowned relative to historic norms. It is estimated that precious metals and precious metals-related securities have a 0.5% market share in the U.S. market versus a 40-year mean of between 1.5% and 2%. So if the tailwinds eventually change investor behavior so that demand for precious metals and precious metals-related assets only returns to mean, demand for those products will somewhere between triple and quadruple. And here's why it'll happen, I think. The biggest institutional investors in the world, the pension funds, the big endowments, the insurance companies, have benefited from 40 years of declining interest rates. And their portfolios have traditionally been 60% equity, 40% debt. The long-term debt, of course, benefits more from declining interest rates. But that party's over. We've seen from the action in the U.S. 10-year Treasury that this 40-year period of falling interest rates is over or almost over. Imagine yourself, Patrick, running a $1 trillion just for fun, sovereign wealth fund, and you own $400 billion in long-term debt. This debt is yielding you 3%, while it is reducing in your ability to service your pension obligations by 8.5% a year. In other words, 40% of your portfolio is guaranteeing that you will be unable to fulfill your mandate. My suggestion is that we're going to see massive disintermediation in the long-term debt market. And while I don't think that all of that money is going to flow into gold, I think enough of it is going to flow into precious metals that precious metals at least resume the market share that would suggest a 40-year mean, which is to say between 1.5% and 2% of the total value of savings and investment assets in the United States. If that would occur, I think that you will see a dramatic bull market in precious metals.
Speaking of gold, a previous guest on our channel mentioned that revaluing gold upwards could be a way for the U.S. to solve its debt problems if they do indeed have that 8,000 plus tons of gold. Could this be the next easy solution after the easiest solution, which was money printing, completely fails?
Uh, Monetizing the U.S. debt in gold is deflationary. It would have an amazing impact on people who had been schooled for 100 years uh, to expect easy money. There would be, I suspect, massive unemployment. I suspect there would be massive foreclosures. I think the idea that the U.S. would ever evolve to honest money is a non starter. I think the political system is at once too ignorant and too cynical ever to allow that to occur.
I mean, despite that, and given your experience, would you say that holding gold and silver pretty much a must today, given the trajectory of the global economy?
I don't want to tell people what to do with their money, uh, but I regard gold and silver as assets that, among other things, allow me to sleep well at night. And at 69 years of age, I like my sleep. It's difficult for me to imagine why somebody wouldn't have some of their have some of their liquidity, at least in gold and silver. If there are people out there whose own business or own investment acumen is so good that they can overcome savings yields in the 3% range while the depreciation of their savings runs at the 8.5, 8.6 level, perhaps they don't need to own gold. If there are people out there who understand a way through $150 trillion in on balance sheet and off balance sheet liabilities at the federal level, perhaps they don't need to own gold. I'm not that smart, so I do.
Okay. Rick, with the US dollar, we of course are seeing it rising on the DXY as mentioned. And this is pretty interesting because on one hand, the dollar is getting stronger, somewhat creating headwinds for things like gold and silver and commodities. And on the other hand, people are selling their assets such as gold and silver to move into dollars. What should an investor weigh in more? A strong dollar to pick up opportunities that are coming, or having a safe haven asset against inflation that'll chip away at its dollars?
Unfortunately, the answer to that is yes, Patrick, and let me explain. Despite the fact that holding cash in any currency reduces your purchasing power, you have to own cash and lots of it. And the negative real interest rate that you suffer, you need to regard as an insurance premium and an option premium. I have been through, depending on how you count, 4 or 5 liquidity squeezes in my life. Crises in confidence, things like 1987, things like 2006. Um, in those periods where liquidity dries up, having liquidity gives you both the courage and the tools to take advantage of market turbulence rather than being taken advantage of, by market turbulence. So, do investors need to hold U.S. dollars? Sadly, yes. Do investors need to own gold and silver? In my estimation, sadly, yes. Investors need to maintain liquidity during periods of change when there is a probability rather than a possibility that we'll have a crisis of confidence and illiquidity. And from my point of view, part of the liquidity which I like to hold is in gold and silver, despite the fact that they are volatile liquidity. It's interesting to me, Patrick, that many people value their gold in dollar terms, which is to say they value an asset that for 1,000 years has been a store of value and is at once a store of value and a medium of exchange. They value it against an artificial construct, the US dollar, a floating abstraction. I try about once a quarter to recast my own personal balance sheet and income statement in grams. That is, I'm trying to teach myself at age 69 to have the constant in my own portfolio, both my balance sheet and my income statement, in gold rather than dollars. I haven't managed to change my mind to do that yet because when I go to the store, stuff isn't priced in grams. But it's very useful to begin the process of programming your mind to at least consider your finances in the context of a constant rather than in the context of a floating abstraction.
Yeah, that is something I do all the time. If I'm at the mall, I'm looking at the price in dollars, and I'm looking at it, well, how much ounces of silver or grams of gold is that? And that's a great point where gold is a store of wealth, but we're measuring against a fiat currency that is losing its purchasing power.
Correct. And in fact, something that's very difficult to value. Remember, and I'm not knocking dollars. Mercifully for me, I have lots of them. Uh, but a dollar and even a bond really is a promise to pay. Gold isn't that, it's payment. You don't have to have any counterparty trust. It is at once a store of value and a medium of exchange. And I'm not saying that gold is going to drive US dollars out of circulation. All I'm trying to say is that in dollar terms, gold is going to revert to its 40-year mean. And I think that will usher in a spectacular move. You should note that in the period 1977 to 1981, that precious metals were double and perhaps triple the 40-year mean, which is to say that the value of precious metals assets at the end of that first bull market were probably 6 to 7% of the value of savings and investment assets in the country. So there's no necessary reason why the ascent of gold and silver's market share would be limited to the 40-year mean, because the circumstance that we find ourselves in today, negative real interest rates, debt and deficits, and quantitative easing, is substantially more dramatic than we have experienced as a society for at least 30 of the 40 years that were covered in the mean.
Rick, I'd like to bring up something that I heard you say in an interview. You had said if you look at the trading volumes around equity markets, speculative markets, some debt markets, the markets are becoming much less liquid. And those markets where they exist are becoming increasingly driven by institutional order flows and ETFs, which means that rather than the market being comprised primarily of living, breathing, thinking human beings trading with each other, it's essentially machine against machine. Rick, what does this mean for the person who wants to own physical gold versus a machine that wants easier to trade paper gold?
Well, I think that is partly a function of preference. And I'm not trying to say that the prevalence of ETFs and the prevalence of machine trading is bad. I'm just suggesting that it is. And that people who are concerned about capital markets familiarize themselves with the fact that things like ETFs, things like programmed trading are increasingly dominant. You won't see as much algorithmic trading in, say, sub $100 million market caps. And what you will see there is a consequence of the fact that most investment and speculation is migrating to machine trading. You'll see increasing illiquidity in the sub 100 million, perhaps sub 200 million market cap space. Two, whether you like it or not, you are going to see more of, as an example, the precious metals markets migrate to exchange traded products or trust products or derivative products like ETFs. You will also, I think, see continued prominence in precious, pardon me, in precious metals in the futures markets, and increasing arbitrage between both the futures market and what you might call spot derivatives, like the ETFs. If, as an example, options or futures on ETFs began to vary with the premiums or lack of premiums, or you could say forwardation or backwardation in the futures markets, you're going to see, I think, uh, increasing machine-driven arbitrage, and I think you're going to see an increasing use of derivatives around any differentials in those futures that you're going to see. The outcome of that, I think, is going to be increased volatility, a lot of increased volatility, and perhaps a continued decrease in the trading liquidity in smaller markets. For me, that'll be hugely advantageous. Uh, if you take junior resource markets back to the illiquidity that they suffered in the 1990s, what you will see is that as the markets become more inefficient, the ability of stock pickers, the ability of securities analysts to pick up really good bargains will increase. At the same time that the arbitrage between larger cap, more liquid names and smaller cap, more illiquid names will mean that there will be more mergers and acquisitions as good financial operators combine three or four 200 million market cap companies into an 800 million or billion-dollar market cap company to avail themselves of this machine-driven or index-driven liquidity. Not a good thing, not a bad thing, just a thing. It's just an is, and you need to take it into account when you allocate both your investment and your trading portfolio.
Okay, and speaking of the future, I saw a comment where one guy said he has to stop watching these types of channels because it's all gloom and doom. Will things get better for us? I mean, what is your 2-year outlook, 5-year, 10-year outlook for the average Joe and then for the wealthy?
Well, tenure, hugely better. I think we have a reckoning to go through first. But when I look at what we've been able to do as humankind in the last 40 years, the incredible increase in living standards that we've seen among all classes of society, but particularly the poorest of the poor, continues. I always joke in terms of optimism that for all the United States' fault, it's still a society where 5 or 6 pimply faced kids can commandeer a garage in Sunnyvale, California, and out pops Google or Facebook, saving consumers tens of billions of dollars a year and making investors tens of billions of dollars a year. What I really like about the future, Patrick, and I'm really excited about this, is, and this is going to make me sound like some politically correct ESG warrior, but society's become so much more inclusive. 35 years ago, women weren't invited to participate. The idea that we ignored half the IQ possessed by humankind was, a real special conceit among people like you and me with outdoor plumbing. The idea that innovation was supposed to come from people who looked like me, old, fat, bald, white guys, it's a pretty dated concept given that we're less than 20% of humankind. What I'm trying to say with all of that is that garage in Sunnyvale, California, that sponsored life-changing technologies, the next garage is not unlikely to be in Lagos, in Nigeria, or in Jakarta, or in La Paz. And that's hugely good. Hugely good. The idea that we are asking all of humankind to participate in our progress is a great thing. The bad thing is that the world's becoming increasingly politicized. And rather than gathering in small groups to voluntarily affect non-coercive change, unfortunately, what we do too often is form ourselves into ethnic groups or religious groups or national groups and try and force our will on each other in coercive aggressive terms, which is to say we go to war as opposed to go to market. I think that we need to get through a reckoning that has to do with our belief in the efficacy of the collective. It's the collective that's given us quantitative easing. It's the collective that's given us debt and deficits. It's the collective that's given us transfers. It's the collective that's given us tariffs. It's the collective that has given us hate. It's the collective that's given us war. And I think we're experiencing a gradual awakening of the fact that we need non-coercive relationships rather than, as an example, nuclear weapons or quantitative easing. I think we need to have a reckoning with regards to a collective consciousness that'll take place slowly. And unfortunately, we need to wring the excesses of our past idiocy out. We learned during the Reagan administration that you don't even need to shrink the size of government. You need to reduce its growth relative to society's ability to foster positive change. It doesn't take really very much of an increase in creativity and productivity and a decrease in government and coercion and theft to restore balance to the world. My sincere hope is that continued growth in China, new growth in India, growth in Pakistan, growth in Malawi, growth in Brazil, growth in Nigeria, growth in the Philippines, allows us geriatric old people in places like Germany and the United States to finance our way out of our historic stupidity. And I'm fairly confident that that'll take place. I just think getting from here to there will be interesting.
Yeah, interesting to say the least. But Rick, those are some of the most those words are some of the most full of hope that I've heard in a while. So I appreciate that. Rick Rule, before we wrap up, can you tell us about Rule Investment Media or other things that you're involved in and how people may contact you?
Patrick, you may know I'm retired or attempting to be retired. I've failed miserably at retirement, and the consequence of that is that I'm deliriously happy. I'm doing several things which might be able to benefit your listeners. The first is Rule Investment Media, where I talk about investments, in particular natural resource investments. And the best way to involve me in that is that any of your listeners who care what I think about their specific natural resource investments can find out for free. Go to a website, ruleinvestmentmedia.com, list your natural resource stocks. Please no crypto, please no tech stocks, please no marijuana or psilocybin stocks, just natural resource stocks. I'll rate them 1 to 10, and I'll comment on individual issues if I think my comments might have any value. The second thing that I'm doing that I'm hugely excited about is I'm celebrating retirement by helping some guys start a new bank. Some of your listeners may remember EverBank, which we took from $0 to $28 billion before we sold it. We're going to do it again with a real focus on precious metals lending. Anybody who cares about my bank, anybody who's unhappy with their current banking arrangements, whether or not they're Americans or non-Americans, are invited when they go to Rule Investment Media to make inquiry of me. Just put bank in the question and comment section. Or else go to website battlebank.com to learn more about what we're doing there. Another thing I'm doing that's really interesting, Patrick, around retirement is I didn't used to be able to talk about private placements too much because as a broker I was deemed to be a solicitor. But I'm not a broker anymore. I'm not getting paid. So I'm putting together a list of people who are interested in knowing what private placements I'm doing. So any of your listeners who are accredited, who care about the private placements I'm participating in, note you may or may not be able to get into them, in that same question and comment section at the Rule Investment Media website, simply write down placements. Finally, for the 30th year running, I think, we are putting on the Natural Resources Investment Symposium. For many years, we put it on in Vancouver, British Columbia. That came to a screeching halt because of COVID. We did it virtually for 2 years. But we're going to do it in person again, this time in Boca Raton, Florida, between the 26th and the 29th of July. This has always been, in my humble opinion, the single finest natural resource investment conference in the world. And I'm so confident in saying that if any of your listeners attend either physically or virtually, because it'll be available virtually around the world, and you don't think you got your money's worth, I will give you a 100% tuition refund. We've had 100% refunds for 30 years, and I'm delighted to say that we have had to refund substantially less than 0.5% of the tuitions we've received over time, simply because the product, in the eyes of the vast majority of the attendees, has been worth more than we charged for it. So once again, Rural Investment Media rankings, bank, placements, conference.
Rick, we appreciate it. I'm sure guys will come on over. Rick Rule, the one and only Rick Rule. We thank you for your time and your sharing your experience, your wisdom with us, and again, the offers. And I hope we can do this again soon.
I look forward to doing it, and I hope you and I have a chance next time to talk about the silver market. I'm really excited about the silver market. I know that some of the silver market participants are a little depressed. I'm elated, and I'd love to have a discussion with you about why.
That was Rick Rule sharing his views on the economy, precious metals, and politics. To hear more of Rick's views and insights, please visit his website, ruleinvestment.com. If you like this video, please subscribe, hit the bell to be notified when we post more content, and give us a thumbs up. We greatly appreciate it. Audio-only versions of this interview can be found on iTunes and Spotify.